Welcome to Breaking News to Trading Moves. Think about the most flawless trade you took recently. You know the one.
Oh, we all have one.
Right. The trend was completely obvious. The horizontal resistance was drawn perfectly. The breakout looked absolutely pristine. You followed every single rule you have ever learned.
To the letter.
Exactly. You waited for the setup, you executed with total precision, and then almost immediately, the price reversed aggressively and took your capital.
Just a total gut punch.
Yeah, total gut punch.
Yeah.
So today, we are going to explore why the market actually hunts your perfection. We want to examine why a trade that looks completely disciplined, totally logical, and, practically flawless on a chart can actually be the most dangerous place to put your money.
It really is.
Our mission today is to look at how markets actually operate out there in the wild, because they do not operate on geometry or, pretty diagrams. They operate on liquidity, timing, and crowd positioning.
And that is a brutal reality that, honestly, every single market participant eventually has to face. Because we are conditioned by school and society to believe that following the instructions guarantees a positive result. If you build a chair and follow the manual, you get a sturdy chair.
Right, it just works.
Exactly. But financial markets operate on an entirely different set of physical laws. The illusion of the flawless setup is incredibly powerful, and it traps people every single day.
Let's paint a picture of that illusion for a second. Picture the traditional, perfect textbook setup. Every trader knows what it looks like.
Oh yeah, you can spot it a mile away.
Right. The price action builds up over time. The horizontal level of support or resistance is painfully clear to anyone with eyes. The breakout is perfectly clean, and the volume appears at the exact right moment.
Every technical rule you've ever read in a trading book just seems to line up in perfect harmony.
It looks beautiful. You click buy, and then your screen immediately turns red.
Why?
I actually like to think about it with a driving analogy.
Okay, let's hear it.
So, relying solely on a textbook trading setup is exactly like following your GPS perfectly, but driving straight into a massive traffic jam.
Oh, that's good.
Right. Because why does that happen? Because every other driver on the road is using the exact same GPS application. They were all routed down the exact same clever side street at the exact same moment.
Yep, the crowd ruins the shortcut.
Exactly. When too many traders see the exact same signal, it becomes completely vulnerable before the move even begins.
That paints the picture perfectly, honestly.
Yeah.
Now, I do think we should clarify that textbook patterns, things like support, resistance, breakouts, pullbacks, flags, all of that, they are highly useful tools.
Sure, yeah.
We're definitely not saying you should throw out your charts or ignore technical analysis entirely. These patterns are essential for organizing price action. They help us make sense of the chaos, and structure the visual data on the screen.
Right, you need some kind of framework.
Exactly. But the danger arises when we take that structural tool and assign a magical predictive power to it.
Right, so the trap is assuming that just because a shape is recognizable, it is somehow guaranteed to work.
Precisely. The problem begins the very moment traders assume that a clean geometric pattern automatically creates a statistical edge. A setup can be technically correct according to the manual, but just horribly positioned in reality.
Like it shows up at the wrong time.
Yeah, exactly. It might appear after an exhausting, prolonged move has already taken place, or it might form right underneath an enormous level of historical resistance.
Which is just a wall.
Right. Or it might trigger right at the moment when earlier participants, the ones who bought the actual lows days ago, are actively taking their profit. The geometric shape itself is not wrong, but the timing, the location, and the crowd positioning are actively working against you.
Which leads us to a really crucial psychological trap. If these setups fail so often, why do we keep falling for them? What is the market actually punishing us for when we take these perfect setups and lose?
That's the million-dollar question.
You noted in our prep materials that the margin is not punishing discipline, it is punishing certainty. But let me offer some genuine pushback on that, because it sounds a bit, counterintuitive.
Go for it.
Well, if we are taught from day one to be disciplined, to stick strictly to our trading plan, and to follow our technical rules without emotion, shouldn't executing a perfect textbook pattern be the ultimate act of trading discipline?
It sounds totally logical when you frame it that way.
True.
It really does. But there is a massive gulf between visual clarity and statistical certainty.
Okay, break that down for me.
Sure. When a setup looks absolutely flawless on the screen, a psychological switch basically flips inside a trader's mind. They stop thinking in probabilities and they start thinking in absolutes.
Like it's a sure thing.
Exactly. The human brain craves completed patterns. When we see a clean triangle or a flat resistance line, our brain gets a little dopamine hit of solving a puzzle.
Oh, wow. Yeah.
And this creates immense overconfidence. A trader starts believing this pattern has to work because it looks so perfect.
And the moment you believe something is a sure thing, your risk management usually goes straight out the window.
You hit the nail on the head.
Mm.
That is where the behavior actively changes. Because the setup looks infallible, traders might, well, they might increase their position size far beyond their normal limits.
Oh, right. They go all in.
Yeah. Or they might widen their stop losses because they want to give this perfect trade more room to breathe. They start ignoring glaring warning signs in the order flow or the broader market context.
So they just get blinders on.
Exactly. That feeling of absolute confidence turns a perfectly valid, logical trading idea into a terribly managed, poor trade. The cleaner the setup looks, the easier it is for the human brain to forget that every single outcome in the market remains entirely uncertain.
So the real discipline is maintaining your awareness of risk, even when the chart is screaming that it is a guaranteed win. We have to, separate the feeling of clarity from the reality of risk.
That is the core of professional trading. Visual clarity is not statistical certainty.
Okay, let's get under the hood here. We know the psychological trap of feeling certain, but what is actually happening in the order book when a perfect setup gets destroyed?
Right, the mechanics.
Yeah, we need to explore the mechanical reasons why these setups actually fail in real time. It all starts with crowded positioning, which I guess goes right back to that GPS traffic jam analogy.
Yeah, crowded positioning is a relentless mechanical force. When a level on a chart is too obvious, too many traders try to enter the market around the exact same price. And the basic law of supply and demand dictates that for a trade to work, for the price to go up, you need someone else to buy it from you at a higher price later.
Right. If I buy at $10, I need a whole new group of buyers willing to pay $11, $12, and $13.
Exactly that. But think about what happens at an incredibly obvious breakout level. If every single trader who wants to buy the breakout has already clicked buy the moment the price crosses that clear line, well, who is left to push the price higher? No one. The buying pressure is completely exhausted at the exact moment the pattern triggers. The bid just falls away. This creates a highly predictable pocket of liquidity that institutional algorithms can easily exploit, purely because the retail crowd has run out of ammunition.
Wait, hold on. This brings up something I really struggle with.
Sure. What is it?
Well, every trading book ever written says, don't anticipate, wait for the candle to close, wait for confirmation. Are you saying the very act of being prudent and waiting for confirmation is what gets you killed?
Yes. Waiting for confirmation is generally taught as a safety mechanism, but it comes with a severe cost that most retail traders do not calculate. By the time that perfect, clean confirmation finally arrives on your chart, most of the actual price movement may have already happened.
Oh, wow.
Right. The professional money, the institutions, and the early accumulators, they entered well before the obvious level ever broke. By waiting for the picture-perfect textbook entry, you are entering the market right when the early money is actively looking to exit and take their profits. You are literally buying their sells.
So you are paying a massive premium for the comfort of a clean chart. You are buying a feeling of safety, but you are sacrificing your actual mathematical edge in the market.
Yeah, you are arriving at the party right as the hosts are turning on the lights and cleaning up.
That's a great way to put it. But, let's say you actually manage to get in early, you beat the crowd, you anticipate well. You could still get completely crushed if you aren't paying attention to the broader horizon. Right?
Oh, absolutely.
It doesn't matter how great your setup is if the location is terrible. It is like trying to bail water out of a sinking boat with a teacup.
A teacup.
Yeah, like your scooping form might be flawless. You are throwing water over the side with perfect rhythm. But the macro environment, the literal ocean pouring through a hole in the hull, is going to overwhelm you completely.
I love that. The teacup analogy is highly accurate for describing location traps. Because you might be looking at a beautiful setup, maybe a perfectly formed bull flag, on a 5-minute chart. It looks like a coiled spring ready to launch.
Right.
But what happens when that 5-minute coil is pressing right up against a massive multi-month resistance line on the daily chart? The higher time frame always dominates the lower time frame.
The ocean always wins.
Every time. A breakout on a smaller chart to look flawless, but if it runs directly into a higher time frame reversal zone, it is going to get absorbed and crushed. The textbook pattern might be correct in isolation, but its location within the broader market context makes it a terrible place to risk capital.
Okay, let's talk about what happens when it does not get crushed immediately, but it just stalls out. You get the trigger, the price breaks the line, you are in the trade, and then just nothing happens.
The sideways.
Yeah. What is actually going on in the order book when a breakout shows weak follow-through? If everyone is buying, shouldn't the price be skyrocketing?
You would think so. But you are forgetting about passive liquidity. When it breaks out and just stalls, it means there's a hidden wall of limit sellers passively absorbing all that excited retail buying pressure.
Ah, I see.
Right. For every aggressive market buyer crossing the spread, there's a larger player on the other side providing a limit order, happily feeding them supply. The tape slows down. When a market triggers an obvious level and fails to accelerate, it is a glaring warning sign.
So it's not resting, it's getting absorbed.
Exactly. It means the larger, well-capitalized market participants have absolutely no interest in chasing those higher prices. They are using the retail enthusiasm as an opportunity to quietly unload their positions.
Which brings us to the most brutal part of this entire process, the liquidity hunt.
This is the painful part.
Let me use another analogy here. Placing your stop loss exactly where the trading textbook tells you to, say exactly one tick below the recent swing low. It is exactly like hiding a spare house key under your front doormat.
Oh, totally.
Right. It is the very first place a burglar is going to look. In the market, it is the very first place the institutional algorithms will look to sweep for liquidity. You put your stop there because the book said it was safe, but because millions of other people read the exact same book, you have just created a giant flashing neon sign that says, "Free liquidity here."
This is a mechanical concept every trader must grasp to survive. Institutional money, the participants moving massive market-altering size, they have a totally different problem than a retail trader.
Right. They can't just click buy.
No, they can't. If a retail trader wants to buy 100 shares, they just click buy. The order fills instantly. But if an institution needs to buy 1,000,000 shares, they cannot just click buy. If they do, they will skyrocket the price and ruin their own entry. They need someone to sell them 1,000,000 shares so they can accumulate their position without pushing the price up against themselves.
So they need an enormous amount of liquidity sitting in one place.
Exactly. So where do they find a massive cluster of sell orders? They find them sitting right underneath the obvious textbook support level.
The doormat.
The doormat. Those are all the stop-loss orders of the retail traders who bought the support. Mechanically speaking, a sell-stop order is simply an order to sell at the market price once triggered. So the institutional algorithms will intentionally drive the price down just enough to trigger all of those stops hiding under the doormat.
The stops trigger, creating a sudden flood of market sell orders.
And the institution happily steps in and provides the buy limit orders to absorb all of that panic selling. They soak up the liquidity, they get their massive position filled at a great price, and then the market immediately reverses and goes in the direction the textbook traders originally anticipated.
Except the textbook traders are no longer in the trade. They got swept. They got stopped out right before the real move happened.
That's agonizing.
It turns a technically correct pattern into a badly positioned trap. The institution is literally hunting the predictability of the textbook setup.
That is the daily reality of the market. And it leads to a psychological chain reaction called expectation imbalance.
What's that?
Well, when a setup is entirely obvious, the crowd forms a unified expectation. Everyone staring at that chart expects the exact same result, immediate, aggressive continuation. But when that result does not materialize immediately, when the price just hovers there, when the bid-ask spread stalls, disappointment and anxiety set in very quickly.
Oh, I know that feeling intimately. You are staring at the screen, your palms start sweating, and you start wondering if you made a mistake.
Yes, that creeping doubt turns into panic. Traders realize the promised move isn't happening. They start rapidly bailing out of their positions just to protect their capital. They hit sell at market to flatten their exposure.
So they become the sellers.
Exactly. That sudden frantic race to the exits creates a sharp, aggressive cascade of sell orders. The failure of the pattern becomes the actual catalyst for a massive move in the opposite direction.
Man, so if we know all these mechanical traps exist, if we know the obvious levels are actively hunted, how do we actually read the tape? I mean, we can't just stare at shapes and click buttons.
Definitely not.
We need to look at the footprints leading up to the crime scene. We need a survival guide to evaluate the broader market context around a trade. So where do we start?
You start by asking how the price actually approached the level in the first place. This is critical.
Okay, the approach.
Did the price slowly build higher lows, resting and gathering strength right below the resistance line. That shows steady institutional accumulation. Or did the price shoot straight up from the very bottom of the chart in one massive vertical line, hitting the resistance while completely exhausted?
It's just totally out of breath.
Right. If it is the latter, the breakout is almost guaranteed to fail, no matter how clean the horizontal line looks.
And you also need to look at momentum and volume, right? Like, was momentum expanding as it approached the level, or was it fading out? Did volume actually support the move?
You want to see broad participation. A breakout on terrible volume tells you that the major players are completely ignoring the move. It is just retail traders fighting amongst themselves in an empty room.
Not a good sign.
Not at all. You also need to watch for acceptance. Was the breakout actually accepted by the broader market? Did price hold above the line, or did it immediately get rejected and return right back into the previous range?
And we also have to check if there is actually enough space for the trade to develop. This goes back to our teacup and sinking boat analogy. We have to look at the macro environment.
You must measure the distance to the next major obstacle on the higher time frame. If your profit target is 20 cents away, but a major daily resistance level is only 10 cents away, the trade simply does not have enough space to breathe.
The math just doesn't work.
The risk-to-reward ratio is entirely broken from the start, regardless of how pretty the 5-minute setup is.
Now, I want to highlight the final crucial question on this survival guide because I think it completely changes how you view a chart.
Oh, this is the big one.
The question is, who becomes trapped if the breakout fails? This just flips the usual trader mindset on its head. Usually, we stare at a chart and ask, how do I win this trade? But this forces you to actively ask, who is about to lose?
That transition is what separates novices from professionals. Novices focus entirely on their own potential profits. Professionals focus on the pain of other market participants.
Because that pain is what drives the market.
Absolutely. The pain of trapped traders is the ultimate fuel for the best, most explosive price movements in the market. If you can identify a spot on the chart where thousands of traders are going to realize they are on the wrong side of the market and panic, you have found a trade with a genuine edge.
So a strong trade is clearly not defined by the pattern alone.
Not at all. A strong trade is defined entirely by price behavior before, during, and after the trigger. The pattern is just the starting point of your analysis, not the end of it.
Right, and this detailed evaluation leads us directly to the practical application. How should we adjust our trading behavior going forward based on all of this?
Good question.
Because the goal here is absolutely not to abandon textbook setups entirely. Support and resistance, trend lines, flags, they all have immense value. The goal is to stop treating them as automatic, robotic trades. You have to start viewing the market as an assembly line where you just punch a button when the light turns green.
You need to adopt a totally different mindset.
Right. A perfect-looking setup does not deserve more trust from a trader. Rather, it deserves much more scrutiny. It is exactly like a business deal that seems too good to be true.
Perfect comparison.
When someone offers you an incredible deal with zero apparent risk, your immediate reaction shouldn't be to just hand over your wallet. Your immediate reaction should be to read the fine print, call a lawyer, and figure out where the catch is.
That is the exact mentality you need to survive. When you see a flawless setup, you need to systematically check the higher time frame. You need to actively study the approach into the level.
Be a detective.
Yes. You must measure the remaining space before the next major barrier. You have to watch like a hawk for any signs of failed follow-through or hidden limit sellers. And you must consider where the obvious stops are likely sitting, so you do not place your own key under that same predictable doormat.
You have to ask yourself an objective question. Is this setup early and balanced, giving me a solid risk profile? Or is it late, incredibly crowded, and painfully obvious to every novice trader in the world?
And if it's obvious, be careful.
Yeah. And most importantly, traders must rigorously define what would prove their trade idea wrong before ever entering the position.
It is uncomfortable to think about losing before you even enter, but it is totally necessary. If you do not know exactly what price action would invalidate your thesis before you click buy, you are not trading. You are just gambling based on a shape.
So true.
The ultimate lesson here is that a clean chart can still contain terrible timing. A strong, classic pattern can still have exceptionally weak positioning. And a perfectly correct directional idea can still produce a painful losing trade if you execute it blindly.
Because the market simply does not care how closely your setup matches the textbook sitting on your desk.
It really doesn't.
The market does not grade you on your geometry skills. It only cares about the relentless mechanics of supply, demand, liquidity, and human behavior.
That is the reality. The setup itself is not the trade. The context around the setup is the trade.
So let's summarize the core lesson here. We have explored why trusting visual clarity over market context is a fatal flaw for a trader. The illusion of a flawless setup tricks our minds into a state of absolute certainty which destroys our risk management.
Right.
We broke down how the mechanics of crowded positioning, predictable stop-loss placement, and institutional liquidity hunting turn perfectly clean textbook patterns into devastating traps.
The traps are everywhere.
They really are. And we walked through a clear survival guide to evaluate the actual behavior of price rather than just reacting to the shape it draws on our screen.
And grasping those underlying mechanics is what elevates a reactive trader into a strategic one.
So I want to leave you, the listener, with a final thought to ponder the next time you open up your charting software. If perfectly obvious, clean textbook setups are exactly the places where retail liquidity gets predictably trapped and swept by institutional money, how might you start looking at your charts not to find the perfect setup for yourself, but to find trades specifically designed to capitalize on those trapped textbook traders?